Hi, good afternoon, everybody. Great to see everyone attending the Insurance, Pension and Wealth Knowledge Plenary. My name is Theron. I look after product development in Schroder, Singapore office. Just want to set the context here for the discussion today. We're looking at contours of opportunities across pensions, insurance, as well as wealth. And I think it's very important that we listen to this because it really concerns your personal wealth. For most of you who are familiar with the Singapore financial landscape, it's quite common for anybody to buy insurance from, say, Prudential. You do your wealth with a bank or someone like Endowus, and you do your pensions perhaps with the CPF board. So it's very disparate, but with technology and advancements in this space, we're starting to see opportunities and possibilities for people to do all three key pillars together in a very holistic manner for their financial plan. And this session is to talk about the kind of opportunities that we see in this space. And today we are joined by rather esteemed panelists featuring different parts of the financial ecosystem. And if I can just quickly introduce them, sitting immediately to my right, Terry, who is Global CEO of DriveWealth, Gregory, CEO of Endowus, and Dennis, who is the CEO of Prudential Singapore. Before we begin, just a few housekeeping matters. We want to keep this an interactive session because it concerns your personal wealth. Please do post any questions that you have with for our panelists through the SFF app, selecting the Knowledge Plenary 2 session. But before we touch on the opportunities in this space, maybe just to highlight a few things about the asset management industry. It came out very strong from the pandemic, and now, as of end 2021, global AUM has actually reached $112 trillion, which represented 12% growth from the previous year and 6.8% growth for the past 5 years. Needless to say, it's been an excellent year for 2021, but 2022 has been almost a reversal of fortunes. No more easy money. Today, investors can get 3 to 4% very easily without even having to do any work. And I just want to kick off the panel discussion by hearing from our panelists. In this kind of environment, has it resulted in any shifts in their business focus and plans? Perhaps we'd like to start off with Dennis.
Sure, thanks very much, Theron, and it's really great to be here this afternoon having the dialogue with panelists. I would answer that question, I guess, from a customer perspective, right? Looking at it through the lens of the customer, I think it's been quite challenging. And if you ask the customer, customers will say that in the recent period, right, things are getting better, but there are also speed bumps potentially. And I think we came from an environment whereby for the past 2 years, due to the COVID situation, and we think that, hey, that perhaps is the past as we learn to live with it in an endemic fashion. Just at that point, you start seeing all the geopolitical tensions happening. You start looking at a steep rise in interest rates, and at the same time, inflation. So from a customer perspective, I think there's that little bit of apprehension, uncertainty, a bit of anxiety, and I think that is definitely very natural. From an insurance industry perspective, ultimately we are in the risk transfer business. And whenever there's all these uncertainties out there for the customer, it's always better for them to at least transfer part of those risks or as much of those risks to an insurer so that they can get more certainties in life. That is what the business is all about. So definitely we want to continue to partner with the customers to give them that assurance.
Thanks, Dennis. Maybe I'd like to hear also the views of Gregory. You're a wealth manager, and we came from a place where 0% interest rates was the norm. Today, people don't have to do anything just to get 3-4%. How does that have affected your business?
I think you have to understand how markets work. And I think we get so distracted all the time by short-term fluctuations and not thinking more broadly about, what it is you're buying when you buy a stock in companies, what it is you're buying when you buy corporate bonds, government bonds, and leaving money in your cash account, earning maybe 3-4% through a fixed deposit. the reason why everything re-rates, so when we say it re-rates, like, stocks will go down, bonds will go down when the interest rates go up, is because the relative risk of owning those assets has to make sense. And every day, hundreds of billions of dollars are traded among people. Hundreds of billions. Actually, if you include currencies and bonds, trillions of dollars changes hands every day. And everyone is trying to create a basket of risk that they can own. So we always say you need to invest based on when those future liabilities, when those future goals are happening in your life. That's how you determine what type of assets you should be invested in. Of course, you also need to match that to your behavioral risk tolerance. So like if you're going to lose sleep if things go down by 10%, then basically you cannot even own a basket of bonds because bonds have gone down by 10% many times in history. People go in and try to buy like a single stock and they realize they don't even have tolerance for things to go down by 10%. A single stock can easily go down by 80, 90%, as we've seen. The global stock market will go down by 50% every 30 years. We just don't know when it will happen. But if you take any rolling period, what we call the risk premiums will persist. So it comes down to having a plan that is rational, that is evidence-based, investing in a diversified manner. And I think what's definitely changed in the last year is the move away from very speculative behavior back to something much more rational. People are much more fearful. They're trying to better understand what it is they should be doing with their money to reach their actual life goals. And I think this is actually very good for markets because things were getting extremely irrational.
Thanks, Greg. For those of you who have not heard of DriveWealth, they are like a technology provider, allowing access to US markets. In particular, Terry was sharing with me about financial inclusion, accessing US markets at fractional shares. So Terry, under this kind of environment, do you see any impact on your business priorities and focus?
Yeah, sure. So DriveWealth powers about 100 fintechs, banks, and brokerages around the world. So we get to see retail investing at scale, and a lot of it is global. So we have clients like Revolut in Europe, or Chipper Cash in Africa, or TOS in South Korea. What we've seen there, first of all, is a desire to own the dollar in today's environment. And the most productive form of the dollar can sometimes be a treasury or a stock. And so our clients have actually shifted more of their assets from their local investing to some of their US investing to get exposure to the dollar. And that's been one of the big trends that we've seen. Overall, what we found is that access to US equities is actually quite tough. One of the things that DriveWealth has pioneered and patented and invented is this idea of buying notional amounts of US equities. Back to your point about what's a good long-term strategy, it's a great long-term strategy to invest in Warren Buffett. He has a stock that trades at $350,000. So I don't know how many people here own a share of Berkshire Hathaway Class A, but it's not that many people. On our platform, you can buy Berkshire Hathaway for $1. And so a lot of what we do is how do we get millions and ultimately tens of millions of people to own US equities in that fractional way? And that's the big shift that we've seen in our markets.
So business has been improving, in fact.
Yes, on our side, we've seen growth. Again, we have more of a kind of casual retail customer who is entering the market and in many ways shifting from some other asset class. Mm-hmm. We aren't a AUM business, which of course that has seen a fair amount of retreat. We also have multiple asset classes, so as people shift from stocks to other asset classes, we're effectively a brokerage platform, and so we see those, that activity is reflected on our platform.
So, a little bit under the spirit of the FinTech Festival, I want to touch a little bit about technology and the advancements and how that's impacting pensions, insurance, and wealth. So I previously mentioned people tend to interact with these three segments rather disparately in a siloed manner. And you see technology eventually removing boundaries between the three. And in fact, yesterday, DPM Lawrence Wong announced that the SG Findex will also start incorporating insurance policies as part of the data exchange that investors can write on and hopefully usher in new innovations in the wealth planning space. So perhaps maybe I'll just open up the discussion to Greg, who is already a pioneer in integrating pension and wealth, because you're already looking at CPF and wealth. Does that mean insurance is next for you? And what are your thoughts of a more holistic financial planning as part of the future?
Yeah, I would say we're very early in sort of wealth and technology being very integrated, right? We know that a lot of wealth management today is completely offline in terms of its experience. So Endowus is very focused on solving the investment part of wealth management. There is an insurance part of wealth management. We acknowledge that completely. But we need to be very focused on solving the investment piece. And not only that, solving it with strategies. So solving it with asset allocation. We have not touched, DriveWealth has done a fantastic job in democratizing access to US stocks all around the world through a ton of different partners. We're very focused on democratizing strategies and giving them to people at a very low cost. So just last week, for example, Endowus launched Bridgewater strategies on Endowus. So you want to buy, you like Ray Dalio, you like global macro as a strategy, you can sign up for Endowus and buy Bridgewater. Endowus also, just a few weeks ago, launched the lowest cost index funds in Singapore with Amundi. So today, Endowus works with 50 over fund managers across 300 over strategies. You can construct your own portfolios, you can fill out your survey, and we can allocate a portfolio for you. And when you invest, you can invest your cash, CPF, and SRS, all sources of funds towards a common goal. And this siloed thinking, I think, is basically the way we were raised. Mm-hmm. It's not the actual way we should be thinking about it. Your CPF is your money. Your SRS, if you participate in SRS, which you should, is also your money. They should not be thought of as separate. They are all invested or all building towards a better future for yourself. So why is it that you invest your cash one way, you treat your CPF another way, you treat your SRS another way? They should all be invested together towards that common goal, and you should be doing it in a diversified way, at low cost, and in a very transparent way. And I think technology has really made that possible for the first time. Just like people are like, oh, why is it taking so long for this transition to happen? And you just need to think bigger. In 50 years, how will people be interacting with their wealth? And then draw that back to 30, 20, 10, 5 years from now. And the adoption will most definitely happen. If you're 50 today, when you're 100, I guarantee you will also be managing your wealth online. I just don't see a way around it. So very, very early in the transition. So,
Thanks, Greg. I hope I'm around by the time I'm 100. I get to live to 100.
Well, you're our latest Endowus client, right? So.
Yeah. No, that's an interesting question, because I'd like to jump back to Dennis. When you think about Prudential, now obviously an institution by itself, product service interface, you have an army of financial advisors. Technology obviously is increasingly a feature of your service. But going forward, when you see technology removing barriers, doing holistic financial planning, how does that affect your business model, the way you think about it, Dennis?
Yep, great question, Theron. When you look at the value chain from an insurer perspective, we always tend to think of it as a manufacturer versus our distributors. And at the same time, when we bring the service out to our policyholders or to the community, I get asked this question all the time, right? Is it it's a question of man versus machine.
Yes.
In that sense, right? Man or machine. Insurance is a very relationship business, and traditionally the large companies over the past many decades would use a sizable agency force to be engaging the public and the policyholders, and that remains. But at the same time, with huge digitalization in the recent years, it's important to see how we get the two to work together. So to me, it's lesser of a man or machine, but it's a man and machine. How can you get these two to really work together? And what I mean by that is harnessing the power of digital, harnessing the power of technology, and using that to enable our agents as they do their work day in, day out to be serving the customers. There are just so many things that happens behind the scenes as we digitize to really enable the entire sales force to be better serving the customers through different experiences on a day in, day out basis. Of course, on the other hand, from a company perspective, there's also this D2C, direct to consumer. But I would say that a company like ours, whereby we have a huge agency force, and that is critical to our business, perhaps it's not just about D2C only, but this whole new notion in the recent period of assisted D2C, and harnessing the power of humans as we go out to serve the customers and using technology. So in the recent period, we kind of tested both models out in the recent weeks, and arguably the results will be more if it's an assisted D2C method than a pure D2C.
Thanks, Dennis. The recent talk, like for the last 12 months, if you have been reading the papers, people are talking about digital assets, cryptocurrencies, AI, all very sexy technology. And just now, when I was having a conversation with Terry, actually it kind of reminded me that not all cutting-edge technology are effective. In fact, something as simple as facilitating access to markets in a very easy, fractionalized manner is technology by itself. So Terry, I just wanted to hear from your thoughts, the kind of trends that you're seeing in your space, and if you kind of space yourself out 5-10 years later, do you see the trends moving towards this kind of futuristic type of discussions, like digital assets? Are these things that you're looking to facilitate access as well? Do you see demand on that side?
Yeah, actually, I kind of like the model that Dennis talked about. There's like this manufacturing side of finance, and then there's this distribution side. And one of the things that I think has happened in fintech is a lot of fintech companies, neobanks, wallets, neo-brokerages, have really figured out how to get better distribution of existing products, right? A neobank is actually a front end to a regulated bank, right? Like the back end of a neobank is just a bank. A lot of neo-brokers are a new interface to an existing set of products. So I think there's a whole trend around how do consumers access some of these products. And that trend itself is upending many of the incumbents. If you look at our markets, we have clients in, I'll sort of look at two markets, in Brazil and South Korea, where we've had fintech companies effectively add digital brokerage inside of their existing apps. Right? One is a company called TOS in South Korea. They're a very large financial services app. They've added a brokerage capability inside of their existing consumer base and very quickly became one of the largest brokers in that country because they just figured out, they went to where the audience was. There was no offline anything, right? It was all online, and they just brought the products to the customer, right? And so through DriveWealth, they just said, if you want to buy $1 of Berkshire Hathaway, click here. And what landed up happening is customers from existing brokers started moving over to these new platforms. Mm-hmm. And then you saw a reaction on the traditional brokers saying, wait a minute, I think we need these capabilities. So a lot of times innovation just comes from perfecting or upgrading how you access an existing market. We saw something similar in Brazil. One of the very early neo-brokers, which we powered, completely changed the way that consumers in that market access equities. And now we're seeing all of the other banks and brokerages, follow suit. So I'm a big believer that distribution by itself can be can increase access and really be its own kind of innovation angle, and the products will follow.
Thanks, Greg. Maybe just something of my own personal interest, because I come from asset management, but we do have some questions coming already from the panel. So I just want to quickly touch, current financial instruments like mutual funds, ETFs, they sound so 20th century. It's almost like as if this was created so many years ago. And I just want to seek the panel's opinion if you think this probably remains the best way to build portfolios. And in fact, today, if you look at what millennial investors are looking for, they want to have an emotional connection to their investment portfolios. Do you think the vehicles that we're using today are too outdated for that, and we are seeing something new in the future? So maybe I can start with Greg, yourself first.
I mean, I think absolutely not.
Okay.
And that they're still extremely relevant. Because what is a fund? A fund is an expression of a strategy. And a lot of strategies have been running in markets for a very long time and require professional implementation to get done properly. So why is it that I wouldn't want to piggyback off of a fund manager managing $1 trillion to execute on that strategy? Now, absolutely, that strategy should be compared against other strategies on a net of fees basis. And they need to compete with each other. Like you said about the manufacturer, I think one thing the internet has done is it allows for the user to more transparently assess their options. Previously, the experience would be I would walk into a bank branch, I get allocated to a stall, I'd walk into a stall, that banker across from me in the stall would sell me whatever fund is on their table that day. Today, you can go into the world of the World Wide Web, and you can see information about a lot of different strategies in real time, or if you want to buy ETFs or stocks, a lot of information about these companies in real time. And there is absolutely, until there's another way, to me, the concept of a fund will never be outdated. Sure, it may take a different form. It may be put on the blockchain or something in the future. It may be in the form of an ETF. The ETF was an innovation for the last 20 years. It may change its form later on, but ultimately, I am buying into a strategy that I want to have implemented properly. And that can be in the form of a mutual fund, a hedge fund, a private equity fund, whatever it is, completely not outdated, if you ask me.
Thanks.
Yeah.
I'm glad, because that means I still have a job.
Actually, I do think one area where we'll see innovation is the way that you wrap those funds. So
Exactly. Yeah.
A big part of for our customers, the biggest innovation in investing is just the default button. What is the default thing that I do? And that drives a lot of activity. So the switch from manual investing and having to figure this out and talk to somebody, how do you do that at scale? And so when you can encode that in some sort of software, whether it's robo-advising or some strategy that's a default in the app, you get higher participation. You sometimes get better results because I don't have to make a decision. I think that's what's changing, is how do you wrap a product? Underneath that, it may be stocks, it may be a basket of stocks, it may be an index, and that has to be dramatically simplified. I don't think most people understand the assets that they own, even after they ask the nice person who explains it to them. And I think interfaces and software will probably do a better job for many people in making those selections for them. And I think we're very early in the robo-advising space, where that's expressed, I think, best.
No, and I think what technology can do is make that expertise delivered at scale.
Yeah.
And then from the data we receive on the way people interact with that product, this is real objective information on how they interact with that product, we can design at scale to create better behavioral change. And that to me is the power of like going digital in this, like we're at the very start of this evolution, the very start.
Can I sneak in a question for Dennis? Because
Yeah.
he said something earlier about transfer of risk, and I'm super curious. In the last sort of 24 months, a lot has happened in the world geopolitically. What are some of the cool things that you're hedging and risks that people are looking to hedge against that maybe weren't on our radar, 24 months ago?
I think from an insurer perspective, we always talk about the two pillars. So one is, of course, wealth.
Yep.
The other one is health. So traditionally, I think there's a lot of products, for example, endowment products and all that, it focuses on your wealth portfolio. But it's important to also look at it from a health perspective. And the last 2 years have taught us a lot of lessons, right? Given the COVID situation, and people are definitely a lot more attuned to protecting themselves and the families. So what we as an insurer is doing actually is to really use technology, and that is something that is a bit different compared to, in the past, we were just a pure, a payer. We are just a payer, right? So you get into a contract with the insurer, you hope you do not have to call on the contract, but if something untoward were to happen to you, an illness, right, medical bills, disability, demise in the family, then you call on that. But we are now pivoting from a payer perspective to partnering. So the difference is actually now partnering and using health and wellness as something that we engage the customers on a daily basis. Because let's be real, right? Would you want to talk to your insurance company 365 days a year? Answer is probably not. But would you want to talk to someone about your health and overall wellness and well-being every single day? You probably have that affinity a lot more. So I think that's something that we are seeing the shift, not just in our company, but from an industry perspective as well. So that's something that's quite interesting, and we are seeing that deepening a lot more.
But no one's buying insurance on a war in a different part of the world or a new viral strain. Like, are you seeing any of those types of insurance requests come in?
Bite-size insurance. So that's something, right? Micro insurance, bite-size insurance, something that you embed digitally, that is beginning to take root. That's something that, again, based on the COVID situation in the past couple of years, say here in Singapore, right? So 2 years back for my company, we didn't quite have that, right? We launched the Pulse app literally 2 years ago during the lockdown. And that has got micro insurance in there, as well as telemedicine. Yes, Singapore is a small country, right? You can run to your nearest clinic or the hospital is quite accessible. But remember, during the lockdown period, people were not so keen to go to actually a lot of these places. So the telemedicine adoption went up. The micro insurance adoption starts going up. Just one use case to share. Dengue is something that people are concerned about in Singapore. So you can literally get dengue protection just with $5 through the app. It's just a simple click, you get the coverage. And we're beginning to see these kind of behaviors change from a customer, from a community perspective.
Thanks. I think I want to spend just the last few minutes to address some of the questions from the audience. Given that it's FinTech Festival, but we do have a number of questions about how about people who are just not as tech savvy? It's kind of an odd question. And I believe, Dennis, you have advisors to help do the non-tech part for you. But how about Greg and Terry? I mean, you are tech-focused guys, but people who don't get tech. How do you address those?
In Singapore, we talk to any client who wants to talk to us. So our view still is we will go and meet the client where they're comfortable. And if that means getting on the phone or meeting up, we will do so and help them through the digital process. Now, we do this with a very small number of, not a very large percentage of our client base. We have 12 MAS licensed reps serving tens of thousands of clients.
Wow.
So that is how, and then we continue to see where we get the most feedback on the app, where we get the most questions, and we build flows and improve the user experience to mitigate some of those questions or make them some more self-explanatory. So again, how do you deliver the best product at a lower cost to serve? Because that will immediately lead to better client outcomes. And that is what we're in a position to do. And we hope to really empower our clients in the process.
Any to add?
Yeah, I think for us, so remember, our clients are large fintechs and banks. They are the ones that are dealing with the end customer. And some of our clients have the most low-tech types of experiences. And even if you're a high-tech person, when you see them, you go, wait, why didn't we think about this before? So I'll give you an example of what Cash App does. So Cash App in the US, that's the largest financial services app. It's got like 40 million customers in the ecosystem. They have a Visa card. And one of the options that they have is a roundup, which means when I use this Visa card to buy a cup of coffee, every time I use it, round up the remaining amount into a stock purchase. So a customer has one decision to make, turn on roundups, and pick a symbol. Usually it's like the S&P, or maybe it's Apple stock. Now, every time I go use my card, if my coffee is $2.40, 60 cents gets taken out of my account and goes into my Apple stock. And it's just a default setting, very low tech. There's no wealth manager, there's no product behind it. And we find that people really like this idea of earning Apple stock when they spend. It's a very low-tech customer who is just effectively saving while they spend. That's just one example. Like, we did not create that experience. We're just the engine behind it. It's our partners like Cash App and Revolut and Toss who create these experiences. And that, I think, is the future of retail. It's really smart fintech companies creating new experiences in ways that a traditional broker-dealer isn't out there with a 60-cent stock purchase.
Thanks, Terry. I think time has caught up with us. So I think we kind of, to summarize the discussion, I think although when SFF, FinTech Festival, technology is having all sorts of promises about pensions, the way you manage your pensions, your insurance, and your wealth, but at the same time, what we heard is we're still very early in the journey, and in fact, not all cutting-edge tech needs to be effective. I think just very simple user journeys of experiences can just solve a lot of the problems other than just cutting-edge tech. And I think that was the key takeaways from the session. And I thank you for your attention throughout the session, and thank you for the panelists for their insights and inputs as well.
Thank you.
Thank you.